Hello, my name is Roxane Webster.
And I'm Keith Alba.
This is the Honest Hour.
Yes, back again for yet another one.
Back again. And this is a cast where we talk about things that we think impact real estate, the economy, jobs, a bunch of other stuff. We try to do so in a low spin environment, except of course, my chair. Ooh, that's the first time spinning in my new office with my new haircut. If you like this content, please share it with friends. And if you want, we would love to have you subscribe, hit the little button beneath it, and then go on over, scoot on over to the notification button, ding, so that you're notified of additional new content as it comes up.
That's right.
So Keith, Alba, what are we talking about today?
Well, as usual, I think we still got to continue to talk about forbearances and what's going on, what we can see is happening with those things and the potential effect that it could have on the real estate market in the future, Rox.
We were one of the first, remember back in March of 2020, seems like 100 years ago, when they started offering these forbearances to folks. You and I were jumping up and down and screaming, oh, what?
Yeah, hang on a minute. What are you getting yourself into before you just jump on this forbearance train? Better understand what's happening.
And we have been expecting and continue to expect to see this hit the market in some way. It has been artificially extended out by a lot of the government funds that we've seen thrown into the economy. And whatever your take is on the wisdom of those moves, there are a lot of people who in their homes right now who wouldn't have been if they weren't in forbearance. But at some point, you owe that money, right?
Yeah, somebody's going to get paid back. Yeah, right.
Right. It takes us back to the two golden rules of banking. Number one is the bank always wins. Number two is that the bank never loses.
Never. Yeah. And the agreements, going back to the origination of the loans was, hey, we're going to give you this money. And in exchange for this money, you're going to pay it back plus some interest costs. So those agreements never changed. Right. And there's just the opportunity to hit the pause button on that obligation. But it was never anything that said those payments are going to get wiped away. You're going to be, forgiven those pieces. It was always just that pause button and the obligation to pay these things back. And so the original forbearance agreements were 12 months maximum in length. And then, towards the earlier part of this year, Biden did extend that so that somebody could be in a forbearance program for up to 18 months on a maximum time scale. And we are seeing a bunch of those forbearance agreements hitting that maximum term.
Why don't you show us some of that Black Knight data you were showing me just to loosen my bowels a little bit? Black Knight is they're lenders, right?
They are they're a company that services lenders. So they've got different tools and software and things for servicers, for loan originators, for different things like that they sell to these mortgage companies.
They're data folks. They're like the NAR for National Association of Realtors from a data point of view to our industry. Black Knight is the lending industry. Though I'm not sure whether or not they do any lobbying.
I don't think they have that lobbying aspect. They're just a private company that has found this niche and used their software that they created for this to kind of compile a bunch of data and information and stuff that's out there. And so this was their most recent report that came out, and it's talking about October of 2021 because I got to look back. But what you're looking at here is kind of the status. And as you see, this is status of the loans left in the COVID-19 forbearance plans. So the blue is the actual number of forbearance plans that are out there. The number is obviously dropping as of November 1st, because people are hitting that maximum term. So they're getting out of that. There's a small portion of them that are paying them off. That may be, through a real estate sale, or they just refinance the loan. And so that original loan that was in that forbearance agreement has now been paid back in full. And it's under a new loan, or the loan has gone. But the biggest thing that I saw here, Rox, and as we start moving along in these months, is the number of people in this active loss mitigation piece. What happens is after you get out of, that forbearance, you have to have a conversation with your bank to try and figure out how you're going to repay back those terms,
What's
those
the repayment terms. That's right.
And the only things the banks, agreed to in allowing these forbearances is it wasn't going to be a lump sum payment. So if you were in forbearance for the maximum 18 months, you weren't going to have to take your mortgage payment, taxes and insurance, and then, make that all 8 times 18 and make it back in one payment. So some of the banks are out there, they're being able just to tack that on. So their 30-year mortgage has now become a 31.5-year mortgage, essentially. Those 18 months
which is fairly painless. And the more that we see, the better. What grabs me with this, I remember back in the Great Recession, being struck at how impactful just the sheer numbers of people going into a loss mitigation department, the strain that it puts on the financial institutions, thinking at the time that even if they wanted to work with people to keep them out of foreclosure, just what company has got the bandwidth to take a little department that may have 5 or 10 people for a national company, and all of a sudden you're looking at millions upon millions upon millions of people needing to work out plans for repayment, even if they were even if they wanted to process those quickly. I just don't see how it happens.
Yeah, I think, they're going to be experiencing a lot of the labor shortage that the rest of the industries are experiencing, and then they have a massive uptick in demand. I mean, just this first bullet point down here, among borrowers who left plans in September through November, only 7% of them are no longer in loss mitigation. So that's some stunning that only 7% have, from September through November, have gotten through that loss mitigation process quickly. Right, the rest of them are still kind of stuck in this loss mit purgatory of sorts, trying to figure out what's going to happen or how they're going to do this. What is the bank willing to accept in regards to payments, and what are they willing to pay? And so, that number, as more and more people hit those maximums, is only going to grow. So there's a big backlog, and what we don't know is what kind of conversations those banks are having with these folks. It may be, this is what your repayment program is. Do you accept it? And they're just dragging their feet because it's nothing that they're able to perform on. And if they can't get an agreement with the banks through this loss mitigation program, that's when you're going to start seeing them jump over to the delinquent side. And then once they're in that delinquent side, if they can't get some sort of payment again addressed, then you'll start seeing foreclosures ticking up. But yeah, this number, I think, is the unknown. That yellow active loss mitigation piece there is how quickly can the banks move through those and get agreements that are both acceptable to them and to the borrower.
That's right.
And if they can't get to that, what's the option, right? And how are these homeowners going to deal with it? Right. Really, I see 3 options. They're going to have to increase their income somehow in order to make the payments that the bank is wanting. They're going to have to sell their house. And if they do that before the foreclosure sale, they'll be able to capture a lot more money and take it that way. Or the bank's going to take it back.
That's right.
Those are kind of the options that I see in regards to those loss mitigations and coming to some sort of an agreement with those banks.
And, when I look at timelines of this, we were thinking about this time last year, we were thinking for second quarter of 2022. I really think that we start seeing the real impacts of this third, fourth quarter of this year, maybe even for second quarter of next year. If you think of worst case scenario, right, we've got 53% of exiting more forborne mortgages in loss mitigation. Let's say they're moving at lightning speed and they get through those in 3-4 months, right? Then if somebody has not paid their mortgage and they're now in default, it's another 3-4 months usually before the bank will initiate a foreclosure. And then at least 120 days until the public sale. So that gets us towards the end of this year on the first round of these, if there are any. The big question is, how are these forbearances going to work? How are these, what is going to be the success rate of negotiating these repayment plans?
Yeah, and I think all eyes are staring at these numbers, right, and seeing, Black Knight gives us a little bit more insight in terms of how things are going with those loss mitigation negotiations. As of right now, it doesn't seem like there's a ton of action or a ton of agreements that are being made, with only 7% of the people from September, October, and November getting some sort of an agreement worked out with those banks. So it's just going to continue to stack up. And at some point, the bank's going to have to cut their losses, right? So if somebody came out of forbearance in August or September, right, how much longer are they going to be willing to wait before starting taking some other action?
That's
and
right.
We saw earlier this year, the CFPB, the Consumer Financial Protection Bureau, put a shot across their bows and basically say, hey, we're going to be watching you guys very closely. We want to see you doing everything possible in order to work out these payments with these folks. And so you better have good documentation and show it. So I think the banks are complying with that. They don't want to mess with the CFPB because they have the authority to just levy some huge fines, which obviously affect numbers and profitability and whatnot. So I think the banks and the servicers are taking that, shot across the bow, and listening to it and saying, okay, we've got to do more than we probably would have maybe in the past, just based off of this warning. But at a certain point, the execs are going to say, okay, we've reached that level of doing everything we can, and now we've got to look at our options and protecting our interests, and that's going to be.
And there are only so long that you can have enormous financial institutions carrying loss forward month after month after month before we see that situation start to filter out into the economy as a whole, like we saw in the Great Recession.
And I think, I guess it depends on the number that come out of it and how aggressively the bank wants it off their sheets, right? And how is that going to affect the real estate economy in the Denver metro area? If we get a decent amount and they all hit somewhere around the same time, and there's an influx of inventory that comes on the market, and the banks are just like, give me a price that it's going to sell it in 30 days, we may see some downward pricing pressure on pricing that's out there.
Especially if that happens at the same time as interest rate increases, which we're going to talk about in another video, right? That would put pressure from two directions. One other slide that I thought was really interesting was the amount of funds that have been used of government funds available for mortgage and or eviction relief.
I believe you're talking about this slide.
That slide, check this out. Orient us, sir.
Yeah, so basically what this is showing is, if I can zoom out a little bit, right there, each state was allocated a certain amount of money from the American Rescue Plan Act. And that was designated towards housing. So we zoom back in here for Colorado, 316 million is the total amount of outstanding principal, interest, taxes, and insurance payments that weren't made by people in a forbearance agreement. So over $300 million of non-paid principal, interest, taxes, and insurance, your total mortgage payment. That's of that, the state of Colorado received $175 million in funds from that American Rescue Act. So if 100% of that money is applied towards those outstanding payments, only 55% of the balance is going to be accomplished by that.
And we know that a whole lot of those funds were not utilized. So that number could be higher.
Right. It could be either not utilized, directed in other ways, maybe towards some of those rental assistance programs, things along those lines.
Yeah, yeah. So all of this, we keep reiterating that when we're seeing just such a hot, rabid Hunger Games market, that it's really hard to believe that anything will ever change. But this has been an underpinning of our economic recovery, is the fact that just this huge housing, right, that drives the economy, and that this huge portion of the economy has been propped up now for, pushing in on 2 whole years. The big question is what happens when they stop. And as we start looking at this, it's going to be very interesting. I, for one, have no crystal ball. I used to be able to predict the future. I feel like, I can't predict laundry day when it comes to the real estate market right now.
Yeah, excuse me. It's an interesting thing. I mean, and that's only dealing with the mortgages, right? And nothing happens in a vacuum. So we'll talk about inflation and the concerns that are about that. How does that potentially affect the stock market, right? And if the stock market, it's been hitting these all-time highs, starts softening, that's obviously going to have an effect. And if all of these things really kind of come together at the same time, man, watch out, buckle up. It's going to be, perfect storm that's going to wreak some havoc in this market. But
well, thank you for joining our Honest Hour. Reminder to click the little subscribe button and scoot on over there and hit the notification bell, ding, and then share this with all your friends, family, hostages, and co-workers to continue getting this fabulous content from us two charming thought leaders. That was all in one breath.
Wow, I'm impressed. Hopefully we get some subscribers from that they're impressed as well. So
excellent. Thank you.
See you next time.